Good morning, everybody. Today is the day. Wednesday, February 1st, 2023. That's the day that everybody's waiting for, right? So let's start with the spreadsheet. In Dark Pool, we print almost $1 million in out of the money puts. But what I'm more looking for is if, makers are looking for 4,100. I have only 2 orders printed in Dark Pool, line 38 in line 44. They sold those calls. They didn't bought those calls. So they are looking for at least like 1.8 or 1.8 million dollars premium. That's what they're looking for. Okay? But we have only 2 orders. It's not too heavy. Why I told you guys that I'm looking for 4041 or 4040 as a support? Because we have 2 orders in the money. There are big orders. It's almost $3 million premium. One, is the 4K call, okay, where the exercise price is 4040, and the another one, the 3900 call, that the exercise price is 3906. Because that I told you guys yesterday, we can see a crazy movement today. We can go up to 4,100 and we can go down up to 3,900, as I told you guys. Basically, those orders will protect the market to not dump, at least to not close below 4K, whatever. That's what I'm looking for. But in another hand, we have a bunch of out of the money put. Okay, we have gamma today. Today gamma. Let me tell you guys. Today gamma is around 4,050. Okay. If you check here, the today gamma is 4,050, 4,060 for put and for calls. So usually gamma is a magneto. Okay. Regarding gamma, the support today is 460. Okay. Regarding our spreadsheet that we monitor Dark Pool, 4,040. And regarding the gross gamma is 4,100. Period. You guys already know all the levels. Okay. 3,906, 4,041, good supports, and 4,100 as a resistance. And also I'm looking for this call as well that they sold back at the end of the last month, that I'm looking for 4,089 as a first resistance prior 4,100. Okay, so between 4,007 and 4,100, that's the resistance region. And between, you see the spreads are bigger. And between 3,960 and 4,041 are the support. We could see a crazy movement today. Okay? But let's look for the Fed funds and the dollar. Let's start with the dollar. They already sunk the dollar. The dollar have been holding very well when I put over here possible bottom accumulation. Okay? Usually by pattern, in the Fed days, if they come as market expect, the dollar prior the effect is spike, not go down. Today is going down. Fed could you become different than what market expect? Yes, I'm not telling that this is gonna happen. I'm telling that yes, could happen. Because by pattern, they are sunk the dollar prior the Fed. Why they do this? Because makers never buy tops, they always buy bottom. Okay? So this is one thing that we need to know. To look. Okay? That's something that you need to look. Dollar could be go down and market could be go down either. Yes, they could. And it's because especially, dollar, the DXY is correlated with our strong currency. If somebody in Europe, for Lagarde, increase the rates higher than, Federal Reserve, we could see, dollar moving down a little bit, because euro you will try to beat momentarily the dollar, in yen, in whatever. Okay, but let's get back. Usually the DXY, if the Fed come as market expected, usually the DXY go up, not go down. Today is going down. Okay, today is going down. So something that you need to look for. Second thing, the yield curve. The yield curve is the worst yield curve ever. Look especially the 10 years minus 2 years. That's the blue line. It's minus 71 points. We never saw such thing before. We already lost the bottom of 1989. Okay? You guys know what's happening those years, right? Observe, as soon the curve, are trading in those levels negative, the markets always go up. As soon they start to fix, markets usually go down. Why? Because they increase the rates, bring recession, because the cost of the money to borrow money is going high, and consequently what you see is a deflation in the future. So in 10 years we will see a deflation pattern. So this is the way that they fix the curve. They bring the yields up. They try to bring the deflation to now. As soon as they bring the deflation to now, and we know that we already have, recession, in the future, because, the 10 years need to be higher than in 2 years. We need to see, inflation in 10 years, not in 2 years. So when they bring deflation, for present, the curve start to going up. Why? Because it's trying to pairing with the 10 years. Cost of the money is getting higher. Okay? They try to bring a deflationary, environment to present, because they already know that the future they are fucked up. And then, the curve is getting fixed. That's easy to understand how the yield curve work. But what they do then to fix the recession? The present recession, not the future. You guys already know that we are fucked up in 10 years. So what they try to do, that's they call soft landing. When usually they fix the yield curve, they start to do soft landing. What's the soft landing means? They stop to hike, and in some point they start to cut. That's the way the economists in Harvard teach the entire world. And consequently, you're seeing this fuck stuff going down again. Because the inflation in the present, you skyrocket again. Right? Period. I don't want to extend more. So, we're not seeing the bottom yet. The bottom is really far. And the yield curve is showing us that we will not see soft landing this year in 2023. 2023 we will see markets bottom. Period. The another thing is the key, the Fed funds. The Fed funds nowadays is pricing 4.5. So they are pricing 25 BPS today. If they bring higher than 25, 50, and they came with a halving speech, we supposedly see the Fed funds going try to backtest 4.75 or 5. What you are seeing here, we are seeing that in 2024, maybe they will start to do a soft landing. It's because that when I see this the Fed funds for December 24, this is for December 24, we see a soft land. I don't know if the bottom will be in March. The bottom could be December. And the market start to be recover next year. And commodities could be start to recover next year. So this year so far, look at what the colors. I'm not looking for a soft landing. This is not printing right now. So far they printed 4.5. That's now is stable, but you see the fluctuation that's always going down. So my call is that they will do hard landing in 2023, 5-6%, and soft landing 2024. So 2023 is bottom. Okay, guys, I'm done for today. I'm expecting a huge spike. Could you be insane? 4,100 back to 3,916 and whatever. Depends what they decide to do. If they wanna, pump the market first, we could close lower. If they wanna decide to drop the market first, we could close higher. Okay? That's usually what's happened. That's the pattern. Other thing that I like to show you guys is the implied volatility. Let's go to charts. If you observe the S&P 500, the implied volatility is over here, down there. When we talk back in Friday, the implied volatility sunk to 16% here, 0.599 multiplied by 100, putting in percentage, is 15.16%. Yesterday, we break the stop, right? We closed at 4,076. But the implied volatility refused to go below 16. The implied volatility, bottom at 17%. When I see this, I'm looking for a divergence, because it's really divergence. When they suppress the volatility, usually, markets going up. That's the pattern. It's because that, volatility guys talk about Vanna and Charm a lot. When the market CTAs, suppress the volatility, they force buybacks. When they force buybacks, markets going up. That's what we saw yesterday, right? The market was going down to 4,020. Then you saw a huge drop in VIX, especially future, from 20.15 for 19.50, and the market spiked. Some zero DTA calls jumping in the book. Suppressed the vol, zero DTA calls, markets going up, expiration of a huge gamma end of the month. CTAs bought $7 billion, as you guys saw, right? Now, if you come to see the put call ratio, here, markets running out of the hedge. Why? Because the data is burning, especially today that you have 30% implied volatility. So maker force the market to be out of hedge. Is because that I told you guys, if a crash happens, need to be this month. If you also look at the spreadsheet, that's the only month that you have the put call rate below 1. Okay? Markets totally bullish in February. Okay? I expect the volatility to be spike anytime soon. I know that, Goldman Sachs, the volatility guy, Saint Croissant, is looking for a rally up to middle February. they could be right. Yes, but they are not makers. Remember, they are not makers. They are CTAs. The volatility could spike today. Yes, that's market. I'm trying to show you guys how market works, the dynamic of the market. I show you guys yield curve, DXY, implied volatility, and the dark pool spreadsheet. I already told you guys the levels that I'm looking for. Take care, be careful.